We're just over 20 minutes into today's session and stocks are in the green. Joining me now is Sean O'Hara. He is the president of Pacer ETF. Sean, welcome.
Good morning. Thanks for having me.
So Sean, what are you tracking most closely during today's session?
Well, I think, there's a bit of a rotation going on in the market. The Mag 7 had led the broad markets for the last several years. I think there's serious questions about the amount of capex that those names are committing to over the next couple of years to build out, AI capacity. And so I think that it's challenging, if you will, their valuations and whether or not they'll eventually make any money on that. And so what we're seeing is sort of a broadening out, and I would love to see that continue. We've exited, I think, what has been a highly concentrated momentum and low quality driven cycle. And I think now investors are starting to think about positioning portfolios back towards quality, value, profitability, and high quality.
All right. And Sean, tomorrow morning, the BLS is going to be releasing that delayed January CPI data. What result do you believe will move markets the most?
I think if we see a number that comes in at or under what the expectation is, I think that will move the markets, because I think that will sort of signal that, the Fed can then continue to lower interest rates. I think, I expect about one, maybe two this year, but I think the market is sort of, waiting with bated breath, if you will, for guidance from the Fed. I don't think they're going to cut this meeting. But if we get a good number and it looks like inflation is coming down and is under control, then I think that would be a signal for the markets that sometime later this year we'll get a little bit more relief on interest rates, and I think that would be viewed as a big positive.
And I understand you're seeing a rotation take shape as it relates to the international market. Can you unpack that for us?
Yeah, well, international has been a tough place to be over the last 5 or 6 years. It's been heavily dominated large cap U.S. market. And I think investors sort of have been underweight international just because it hasn't been a very attractive place to be. Although we've started to see it at Pacer ETFs, we've started to see a lot of flows into our international strategies, whether it's global, which is GCOW, or pure international, which is ICOW, or a product that we have with NASDAQ that symbol's patent. I think investors are now starting to rethink their asset allocation and are moving a little bit more aggressively towards international, sort of based on two tails of valuations. One is our markets are highly valued, and the international markets are a little bit less in terms of PE. And so, I think it's a good thing for investors to start thinking about maybe beefing up their international exposure towards, those levels that they would normally be, since we've been underweight for a while. And so we've seen a big change in our business, not only back to quality in the U.S., but also big flows into international equities as well.
And Sean, what sectors are you monitoring as potential market movers in the coming days and weeks ahead?
Well, I mean, tech is going to be important to watch. I think it's under a little bit of pressure now. We're overweight energy in some of our stuff. We're overweight healthcare. We're overweight the consumer on both sides, staples and discretionary. And I think, those are the sectors that have lagged, if you will, over the last several years. But they're starting to pull up a little bit. So I continue to watch, what day to day each individual sector is doing to contribute. Financials have been under a little bit of pressure with with all this AI scare. I think it's probably a temporary thing. I think the AI tools that everybody's afraid of are actually going to help financial advisors serve their clients better. So, but financials in the short run really have been taking a bit of a hit.
All right, Sean O'Hara, president of Pacer ETFs. Thank you so much for joining us.